All right, let's just dive right into this explainer and demystify some of those financial crossroads that tend to overwhelm, well, pretty much all of us. And don't worry, we're doing this completely jargon-free. So, did you know the average person actually loses hundreds of thousands of dollars over their lifetime? And it's all just lost to hidden fees and unoptimized savings. We're going to be looking at something I like to call the escalator of wealth. Because think about it, how often do we get stuck overthinking a $5 coffee, while at the exact same time, we're completely ignoring the tens of thousands of dollars we might be losing in hidden housing costs or high-fee investments? It is so easy to get lost in the noise, but today we're going to fix that disconnect and clear a path to some genuine financial understanding.
So here's our escalator for today. We're starting with surviving daily money traps, then moving up to earning more and borrowing better. After that, we'll tackle the big financial debates, and finally, we'll lock in that final money mindset. Let's start the climb.
First up, surviving daily money traps. We really need to master the psychology of our everyday spending.
Because honestly, before we can even think about conquering Wall Street, we've got to conquer our daily habits. Let's look at a scenario we've literally all lived through. You're out to dinner with friends. You responsibly ordered, say, a small side salad and a tap water, but the person across from you, they ordered a massive tomahawk steak and 2 dry martinis. Then the check drops and someone casually goes, "Hey, let's just split it evenly." Right? We all know that visceral panic in that exact moment. Why does splitting the bill never feel fair? Well, it proves that money isn't just math, it's highly emotional. It represents our time, our energy, and our personal boundaries. And when those boundaries get crossed to subsidize your friend's luxury dinner, it causes this immediate psychological friction.
And you know what that friction usually triggers? The guilt spiral. Step 1 is the urge. You're stressed out, so you start browsing online. Step 2 is the purchase, bringing you that quick dopamine hit. But then comes step 3, the guilt. That's waking up the next day and realizing, yeah, I definitely didn't need a third blender just because it was on sale. Which leads right into step 4, restriction. You punish yourself by declaring a total spending freeze. But here's the catch. That strict restriction just creates way more stress, which drops you right back into step 1. It's a vicious cycle. So when we try to fix these habits and break out of the spiral, society constantly tells us to budget. But we really need to compare the guilt-inducing nature of budgeting against the absolute clarity of simply tracking your money. See, budgeting is inherently restrictive. It sets strict rules for your future spending. Tracking, on the other hand, is simply observing your past and present spending habits, almost like a scientist. You're just gathering data on yourself, entirely without judgment.
And tracking actually fixes your finances a lot better, simply because it completely removes that emotional guilt spiral. When you operate on a strict budget and accidentally overspend by, say, $50, you feel like a total failure, and you're tempted to just give up on the entire month. But when you just track your expenses, a $50 overspend is just a neutral data point. If you see you spent $200 on takeout, tracking doesn't scold you. It just asks, "Hey, did you enjoy the food enough to do it again next month?" It lowers your daily stress and lets you effortlessly adjust your behavior. Honestly, it's incredibly empowering.
Moving up to level 2, earning more and borrowing better. This is all about leveraging your time and your credit. All right, it's time to start playing offense with your finances. Now, if you spend even 5 minutes online, you'll hear that everyone supposedly needs to start a side hustle. It's like the modern gold rush, right? But we seriously need to weigh that against the much more traditional route of just fighting for a promotion. A side hustle requires you to dedicate your precious extra hours, those exhausted evenings and weekends, to build a diversified income stream from absolutely zero. A promotion, though, strategically maximizes the hours you're already working. You're leveraging your existing reputation for a much higher base pay, completely without the burnout. In a lot of cases, a promotion grows your income far more efficiently because the hidden time cost of a side hustle leaves you with zero margin. I mean, literally zero. That is your free time when you're burning the candle at both ends. Before you sacrifice your health, your hobbies, and your relationships for a few extra dollars on the weekend, you've really got to run the numbers and see if applying that exact same intense focus to your 9-to-5 would just yield a far greater return on your time. Next up, we have to completely reframe how we view borrowing. Because separating debt into good and bad categories is the secret difference that changes absolutely everything. Debt is just a tool. A hammer can build a house or it can smash a window, right? The tool itself isn't inherently evil, but exactly how you use it is what dictates your financial future. So here's what this actually means for your overall net worth. You want to aggressively eliminate the bad debt while strategically managing the good debt. High-interest credit cards and luxury car loans, that's bad debt. They're used to buy things that immediately lose value. You are literally paying banks a premium to lose your own money. But sensible mortgages or strategic education, those are investments. They are calculated risks taken to acquire assets that appreciate or drastically increase your earning potential over time. All right, stepping up to part 3, the big financial debates. We're tackling housing and the stock market. Now, these are the conversations that absolutely dominate dinner parties and financial news networks. Let's cut through all that noise. Is renting actually throwing money away? It is, without a doubt, the most common financial myth society feeds us. We've all heard some well-meaning relatives say it with absolute certainty. Well, let's bypass the well-meaning advice of our relatives for a second and look at the undeniable math to find the truth, rather than just blindly following cultural traditions.
We are essentially pitting the absolute flexibility of renting against the monumental American dream of buying a home. And here is the reality check. When you rent, your rent payment is your predictable maximum monthly cost. That is the absolute most you will pay for a roof over your head that month. But when you buy, your mortgage payment is your minimum monthly cost. You are building equity, sure, but you are also exposing yourself to massive, entirely unpredictable financial shocks. Seriously, when you start looking at the unrecoverable costs, like the fact that maintenance averages 1 to 4% of a home's value every single year, you realize renting isn't just throwing money away, it's paying for predictability, property taxes, replacing a collapsed roof, huge closing costs, and rising insurance premiums. Those are all unrecoverable. You do not get that money back when you sell. Renting is simply trading money for a service and peace of mind. Buying a house is fantastic, but only if the math works for your specific timeline, not just because society told you it was a mandatory milestone.
Finally, when it comes to the stock market, we have to look at the battle between active stock picking and boring passive investing. Active investing is all that exciting stuff you see in movies, right? Trying to time the market, picking the next big tech stock, moving money around constantly. Passive investing is simply buying a broad market index fund, owning a tiny piece of thousands of companies, and then, going outside to enjoy your life. And incredibly, actively managed funds routinely failed to beat a simple S&P 500 index. There's actually a famous experiment where a monkey throwing darts at a stock board outperformed professional hedge fund managers.
If you look at it over a 20-year period, the active investors' returns just get eaten alive by management fees, taxes on all those trades, and the simple fact that no human can consistently predict the future. Meanwhile, the passive investor's portfolio steadily compounds, riding the undeniable upward trend of the overall market. They build massive wealth simply by getting out of their own way. Boring is incredibly profitable.
Bring us to part 4, the final money mindset, putting it all together.
So, we've gone from the dinner table to the housing market, really blending the psychology of money with the hard math. We've seen exactly how our daily habits connect directly to our macro wealth strategies. Now, I want to leave you with one final question to challenge your assumptions, because taking control of your wealth starts the exact moment you turn off the autopilot. Are you making your financial decisions based on the actual math, or are you just running on societal autopilot? Are you budgeting because you think you have to, or are you tracking to actually learn? Are you grinding a side hustle because it's trendy, or are you optimizing your income strategically? You've got to stop doing what everyone else is doing just because they're doing it. Look at the real math and start making decisions that actually serve your unique life. Thanks so much for taking this ride up the escalator with me today in this explainer. Now go take control of those numbers.